If I handed you £1,000 to invest today, would you put it into the S&P 500 or the FTSE 100? Well, your answer might be about to change. Welcome to Joe Invest, where today we are talking about two heavyweight stock market indexes to find out why the narrative of the stock market may be shifting. We'll be comparing the S&P 500 in the United States and the FTSE 100 in the United Kingdom. Let's dive into it. To start, we need to look at the basics. The S&P 500 tracks 500 of the largest publicly traded companies in the US. The FTSE 100 tracks 100 of the largest publicly traded companies in the United Kingdom. Now, if we zoom out on a line graph of comparable historic returns, we can see the S&P 500 has practically always dominated the two indexes, leading the way with growth of 698% returns in comparison to 211% with the FTSE 100. This is because it includes many innovative, mobile-driven companies, especially in technology and consumer sectors. Strong corporate earnings, consistent growth have always boosted the S&P's performance. But if we start to zoom in and look at the graph over the last 3 years, we can see the S&P 500 leads the way with returns of 55% compared to 42% of the FTSE 100. But as we can see, that gap is getting smaller. That brings us to today. Now, at first glance, if you look at the evidence I've just provided, you would think the obvious answer to investing your £1,000 would of course be the S&P 500. But that raises the question, why are so many investors placing their bets with the FTSE 100? And the answer is actually in the last 365 days. Look at this graph over the last year, it seems the tides have started to shift. The FTSE 100 has dominated the S&P within the last year, with returns of around 15.5% in comparison to the S&P's 3.85%. But the question is, why is it changing? Well, it's all related to the forward PE ratio, which is essentially a trading company's stock price divided by its projected earnings per share. We need to remember that the stock market is priced accordingly with how investors project a company's earnings, meaning if more people think a company's earning reports are going to be positive, naturally they will invest in the company hoping the earnings reports will be positive, and which will collectively drive the share price up. Now, if we look at the S&P 500's forward PE ratio evaluation, we can see it is currently reported at 22.9 at the end of October, significantly above the last 30-year average of 17.1. And if we actually look, it's beginning to reach similar heights to the dot-com market crash, where the market fell 77% due to hype and speculation in internet-based companies. So why is it so high? It's largely driven due to anticipation and speculation of artificial intelligence. And this is why many investors are concerned that history might repeat itself. If we look at the S&P 500 sector diversification, we can see that the tech sector dominates the fund with nearly 37% of holdings, and second place currently sits at around 11%. And again, this is reflected by the top 10 company holdings, with Nvidia, Microsoft, Apple, Meta, Alphabet and Tesla all placed within the top 10 holdings, all of which are leading companies in artificial intelligence and innovation. In comparison, if we jump back over to the FTSE 100, although we couldn't find an accurate graph of the forward PE ratio, I found a UK MSCI valuation which gives us a good coverage of the UK stock market as a whole. And as we can see, the forward PE ratio is currently around 12.7. Now, after asking ChatGPT to estimate the average of this graph, I was given an approximation of around 13 to 15. Which would indicate the FTSE 100 share price is actually very well valued and maybe even tinkering towards being undervalued. And why is this? Well, if we look at the top 10 holdings and sector diversification within the FTSE 100, not a single of the top 10 holdings are classed as tech companies. If we look at the sector diversification, the technology industry only actually makes up 1% of the FTSE 100. Instead, it predominantly focuses on financials, consumer staples, industrials and so on, all of which have stood the test of time, and during times of uncertainty, like we are in right now, all of which seem to stand their ground over the likes of modern day innovation, such as technology. Well, to summarise, the S&P 500 is built for growth, and the FTSE 100 is built for resilience. Let me share my own strategy. I currently have over £22,000 in the S&P 500, and I plan to keep it there. I still believe in long-term US growth and innovation, but going forward, I'm planning to diversify, especially into UK stocks, particularly those with strong dividend yields, strong fundamentals that are currently undervalued and have stood the test of time. So I'm not betting against the S&P 500, but I think the FTSE 100 finally deserves a seat at the table.